Turning 40 changes the financial math. You move from simply trying to accumulate as much wealth as possible into a phase where you actually have to protect what you've built. This chart shows the timeline for a 40-year-old. You have roughly 20 years of peak earning capacity left, this accumulation block here. But that has to fund a much larger 30-year retirement block right next to it. If your portfolio doesn't grow faster than inflation and your withdrawal rate, your capital drains to zero before the 30 years are up. Running out of money is the single biggest threat in this decumulation phase. Because the retirement window is longer than the remaining working window, the math is unforgiving. You no longer have the time to recover from major strategic mistakes. For Hong Kong residents, the standard financial advice they grew up with mathematically fails to solve for this new, rigid timeline. The most common local strategy is buying Hong Kong dividend-paying blue-chip stocks, like HSBC or Town Gas. While these pay attractive dividends, they often act as a yield trap. The high payouts mask a business model with almost zero long-term capital appreciation. Your principal simply erodes against inflation. The modern alternative is to buy the U.S. market directly through an S&P 500 ETF, typically Vanguard's VOO. But for a Hong Kong resident, buying a U.S.-domiciled fund triggers a mandatory 30% withholding tax on all dividends. Over 20 years, that creates a massive drag on your compounding returns. Worse, if you pass away holding more than $60,000 in U.S. assets, the U.S. government levies an estate tax that confiscates up to 40% of the excess. It severely compromises your ability to pass wealth to the next generation. So at 40, you are stuck. You have to choose between stagnant local stocks that lose purchasing power or high-growth U.S. assets that leak capital to foreign taxes. You need a structural alternative. The solution is the 70-20-10 portfolio. This allocates 70% to a core U.S. equity engine, 20% to global yield, and 10% to a liquidity buffer. The 70% core engine replaces VOO with FUSA, the Fidelity U.S. Quality Income ETF. FUSA is domiciled in Ireland, not the United States. Because of Ireland's tax treaties, this offshore structure completely bypasses the U.S. estate tax. It also immediately cuts the dividend withholding tax from 30% down to 15%. FUSA is also an accumulating fund. U.S. law forces domestic ETFs to pay out cash dividends, which you then have to manually reinvest, incurring transaction fees. An accumulating fund automatically reinvests those dividends internally. Your money stays in the market, maximizing tax-free compound growth without any extra trading costs. There is a clear trade-off. Because FUSA doesn't blindly track the largest companies by market cap, it will trail VOO during bull markets, driven by a handful of mega-cap tech stocks. But when you have a 20-year retirement timeline, plugging a 40% estate tax leak and automating your compounding yields a far more reliable result than chasing peak market rallies. FUSA operates on a smart beta strategy. Instead of buying the 500 largest U.S. companies, regardless of their financial health, it filters the market for quality. This chart shows the exact screening process FUSA uses. It specifically targets companies with high return on invested capital and stable free cash flow. By forcing companies through these layers, the fund strips out deteriorating businesses before their stock prices collapse.
We saw exactly how this performs under pressure in 2022. As inflation surged and interest rates spiked, the broader market crashed. This chart compares the resulting drawdown. The standard S&P 500 dropped over 18%. FUSA's quality screening restricted its fall to just 5.25%. Now, FUSA charges a 0.25% management fee, which is higher than VOO's 0.03%. However, the 15% you save on dividend taxes mathematically offsets that fee difference. That fraction of a percent buys you a structural shield. It ensures a severe market correction won't decimate your core wealth right as you transition into retirement. That brings us to the remaining 30% of the portfolio, the global hedge and the liquidity buffer. 20% goes to VHYA, Vanguard's global high-yield ETF. This captures quality European and Japanese yields, diluting your reliance on a single US-centric market. The final 10% solves for sequence of returns risk. If you retire the exact year a multi-year bear market begins, withdrawing funds locks in permanent losses that can bankrupt your entire plan. To neutralize this, you allocate 10% to SGOV, U.S. short-term Treasury bonds. This acts as your financial and psychological shock absorber. If the equity market crashes in year 1 of your retirement, you don't sell your FUSA shares. You live off the cash generated by the SGOV bonds while your stocks recover. The trade-off is cash drag. Holding 10% in safe short-term bonds will slightly reduce your total portfolio growth during a raging bull market. You are sacrificing absolute peak returns to buy psychological certainty. The buffer guarantees you can ride out a crash without outliving your capital. Side-by-side comparison, HK stocks and 70-20-10 have zero estate tax risk. VOO carries 40% risk. On downside and tax drag, local stocks offer low growth. VOO brings high volatility and 30% taxes. The 70-20-10 lowers volatility and cuts taxes to 15%. Adopting the 70-20-10 does require setting up an offshore broker like Interactive Brokers. It takes more effort than just buying a local Hong Kong S&P 500 ETF like 9195 through your current bank. But the math demands the effort. That local ETF charges a hidden 0.79% fee compared to FUSA's 0.25%. Over 25 years, that 0.5% difference will eat hundreds of thousands of dollars of your retirement principal. Enduring a little setup friction offshore is the price you pay to protect your long-term compounding. This chart shows exactly where the 70-20-10 portfolio fits. It sits squarely in the moderate risk mid to long horizon quadrant. If you are 25 years old with decades to recover from a 40% market crash, this defensive strategy is too conservative for you. A younger investor should favor a 100% allocation to an Ireland-domiciled S&P 500 ETF like CSPX to push for absolute maximum growth. But if you are a Hong Kong resident between 40 and 50, your math has changed. You are transitioning from pure aggressive growth into structural wealth preservation. This specific blueprint legally shields your wealth from the IRS, automates your compounding without transaction fees, and builds the cash buffer you need to survive recessions. The 70-20-10 strategy isn't designed to beat the market. It is structurally designed so that foreign taxes, sudden market crashes, and just plain bad timing cannot beat you.